Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
In today's episode, you'll learn about, first, today's US market review. Tech stocks skyrocket on dovish Fed signals, but this euphoric rally masks a treacherous truth market breadth is collapsing, flashing critical danger signals of a potential bubble burst. Second, Nvidia vs. The Big Short. A secret memo triggers a Wall Street shadow war over the $3 trillion AI bubble. Is this just a replay of the dot-com crash that will wipe out billions or the dawn of a new tech dynasty? Finally, crisis alert. A JPMorgan bombshell study reveals a silent income crash for millions of Americans. While headlines boast low unemployment, the truth is a K-shaped disaster looms, threatening to trigger a major consumer spending collapse. Listen up, folks. The Fed just pulled a rabbit out of the hat with unexpected dovish signals, and tech stocks are skyrocketing. The S&P 500 climbed 1.55% to 6,705.12, while the Nasdaq surged 2.69% to 22,872.01. This is a game changer, driven by New York Fed President John Williams hinting at potential rate cuts. The market's mood, euphoric for tech, but beware, the broader landscape is more complex. Now, let's break it down. The Fed's dovish pivot is a seismic shift, pushing rate cut probabilities for December to a whopping 68 to 81%. This is a stark contrast to midweek forecasts of only 30%. The impact? Treasury yields are plummeting, with the 10-year yield down to 4.06%. But here's the kicker. This optimism might be a house of cards if Fed Chair Powell doesn't reinforce it before the blackout period on November 29th. Historically, such a swing in rate expectations sparks a tech rally. Remember, high-duration growth stocks typically gain 2 to 4% within days. Yet, the undercurrent of weak economic data, like the ADP report showing private sector job cuts, looms large. The money flow is telling us something crucial. Institutional investors are piling into tech, betting on lower discount rates to boost valuations. But the VIX dropping 6.82% to 19.12 suggests a complacency that might be premature. Remember, with only 69% of stocks participating in this rally, breadth is narrow. This rally is driven by a few mega cap tech names: Apple, Microsoft, Alphabet. The valuation bubble is inflating, with tech P divided by E ratios soaring well above historical norms. If bond yields reverse or tech earnings disappoint, watch out, this bubble could burst. So, what's the strategy? I'm telling you, this is your last chance to rebalance. Rotate out of overvalued tech and into small cap and value sectors. The Russell 2000's 2.1% rally is your cue small caps are breaking out, but keep those hedges tight. This isn't an all clear signal for equities. Now, let's zoom in on sectors. Communication services, driven by Meta's 3.8% jump and Alphabet's 3.2% rise, is leading the charge. The catalyst? Meta's potential pivot to Google's TPUs from Nvidia's GPUs. Nvidia's stock took a hit, down 6%, as fears of competitive erosion mount. Advanced micro devices also fell 4.2%, showing the sector's vulnerability. Meanwhile, the financial sector with ETF code XLF is a stealth winner, poised to benefit if the Fed cuts rates. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Short term, if Nvidia breaks below $170, act now to establish a tactical short position. Use NVDA puts or inverse ETFs to hedge. Medium term, if the 10-year Treasury yield climbs above 4.5%, overweight financials by 3 to 5%, XLF is your target ETF. Defensive play? If consumer confidence dives below 85 in December, increase your allocation to staples and utilities by 2 to 3% each. Think XLP and XLU. Let's wrap this up. The Fed's dovish signals are a double-edged sword opportunity if they stick, disaster if they falter. Watch Powell's comments post-blackout and keep an eye on December CPI and retail sales reports. Time's ticking. Let's dive deep into today's critical market dynamics. The fight between Nvidia and one of its loudest naysayers, investor Michael Burry, is escalating. The chipmaker has quietly circulated a private 7-page memo to Wall Street analysts, explicitly name-checking Burry to push back on his claims that the AI boom is a bubble on the verge of bursting. A while back, We walk through Nvidia's blockbuster backdrop, $500 billion in chip orders, stretching into 2025 and 2026, and a blowout quarter followed by an even bigger guide. That context matters here because the company is now using that momentum to argue this isn't a replay of the dot-com era. Burry, the investor made famous by The Big Short, is warning that today's AI infrastructure frenzy mirrors the late 1990s telecom build-out. He points to a jaw-dropping number: hyperscalers promising nearly $3 trillion in AI infrastructure spending over the next 3 years, calling it a supply boom mistaken for durable demand. Here's where it gets interesting. The whole debate revolves around something called capital expenditure or capital expenditure. This is the money big companies spend on physical assets like data centers and servers. Recent data shows that spending by these hyperscale cloud providers surged an astonishing 72% year over year, primarily driven by AI. So the thing is, this spending spree is far outpacing the actual revenue currently being generated from AI applications. This is the core of the bubble fear, a massive investment in supply before the demand has been proven. As we noted a while back, this sits inside what economists are calling an AI capital expenditure supercycle, creating a two-speed economy and widening the gap between reported profit and free cash flow at the big spenders. That FCF gap is a tell we've been tracking, even as headline growth looks terrific. In a direct response, Burry didn't mince words, stating, "I am not claiming Nvidia is Enron. It is clearly Cisco." The heart of his argument is a chilling history lesson. In the early 2000s, after telecom companies spent tens of billions on fiber optic cable and Cisco gear, less than 5% of all that new capacity was ever actually used. Burry believes the AI market is making the exact same mistake, resting on overly optimistic assumptions. We previously analysed how Nvidia's recent results, like that $57 billion quarter and a $65 billion next quarter forecast, push back on this narrative. Jensen Huang even told investors, "From our vantage point, we see something very different. That performance doesn't settle the debate, but it's the evidence Nvidia is leaning on as it counters Burry now." So you should be watching the ratio of AI-related revenue growth compared to this massive capital expenditure spending. If revenue from AI services doesn't catch up to the infrastructure investment, it would validate Burry's thesis and could signal a major correction. Alongside that, keep an eye on free cash flow at the biggest buyers. As we've discussed, those capital expenditure lines can climb while FCF gets squeezed. That's the on-the-ground check of whether this wave is self-funding. And don't forget the demand wildcard we flagged. Sovereign AI, nation-level GPU programs are less price-sensitive and could extend the cycle even if corporate spending slows. But Nvidia is fighting back point by point in its private memo. The company refutes Burry's figures on stock buybacks, stating it repurchased $91 billion in shares, not the $112.5 billion Burry claimed. Now, get this. The reason this buyback number is so contentious is because tech giants like Nvidia use huge amounts of stock-based compensation to attract top talent. To prevent this from diluting existing shareholders, they then use cash to buy back their own stock. This practice can also inflate a key metric called earnings per share, or EPS. The debate isn't just about the dollar amount, but whether these financial maneuvers are masking the true costs and creating an illusion of higher profitability. This ties back to our earlier point. Watch the gap between reported profit and free cash flow, especially in a super cycle, because that's where the strain shows up first. It also counters that its GPUs have a real-world lifespan of 4 to 6 years, not the shorter 2 to 3 years critics suggest, and that fears of circular financing with AI startups are overblown. Remember, a few days ago, we flagged concerns about pulled forward purchases ahead of tighter rules. Despite that, Nvidia's step-up revenue guide suggested demand was still running hot for now. Believe it or not, that GPU lifespan ties directly into an accounting concept called depreciation. Companies have to estimate an asset's useful life and write down its value over time. Currently, major cloud providers like Amazon and Microsoft have not shortened the official depreciation schedules for their servers. This signals they believe the hardware will remain valuable for years, supporting Nvidia's claim. However, if they were to suddenly accelerate depreciation, it would be a massive red flag that the technology is becoming obsolete faster than expected, forcing huge earnings write-downs. And speaking of financing, that term circular financing has been thrown around. It's a scenario where a company like Nvidia invests in a startup, and that same startup then uses the investment money to buy Nvidia's products. This creates a self-referential loop where demand might not be organic. We know Nvidia has invested in dozens of AI startups that are also its customers. The concern is that this demand is fragile and depends on the venture capital market, not on real sustainable business. As we've been tracking, the rise of sovereign AI countries building national GPU capacity creates a separate, geopolitically driven demand stream that's less sensitive to funding cycles. That's a key offset to watch alongside hyperscaler budgets. However, if you zoom out, you'll see another layer of strategy at play, and this one has huge implications for our listeners in Asia. Nvidia's dominance has created a geopolitical choke point. This concentration of advanced AI chip design in one company is amplified by US export controls on China. This has forced Nvidia to create special, less powerful chips like the H20, specifically for the Chinese market. The result is a potential fragmentation of the global AI ecosystem, a kind of technological iron curtain that could slow innovation and raise costs for everyone, directly impacting China's own AI industry and its ability to compete. We highlighted earlier that Nvidia itself acknowledged sizable purchase orders never materialized in one period due to geopolitics, with export controls cutting into high-end market share in China while accelerating China's domestic alternatives. If controls ease after precautionary buying, that could create an air pocket in demand. If they tighten, it further entrenches fragmentation. The battle lines are drawn between the legendary investor who predicted the 2008 crash and the undisputed king of the AI chip market. While Nvidia's memo rejects the comparison, Burry is doubling down, framing this as a repeat of history. As he wrote, and once again there is a Cisco at the center of it all, with the picks and shovels for all and the expansive vision to go with it. Its name is Nvidia. From here, the dashboard hasn't changed. Watch hyperscaler capital expenditure guides, watch the gap between profit and free cash flow, and watch the sovereign AI pipeline. A while back, Nvidia's finance chief said of that $500 billion order book, the number will grow. Today's memo is the company's latest case for why. Speaking of these immense economic pressures, let's shift our focus from corporate giants to the American household, where a silent crisis is brewing. Let's start with a single statistic that might just change your entire perspective on this. Half of all American workers between 50 and 54 years old have effectively taken a pay cut, with their earnings completely erased by inflation. Now, this specific age group, the 50 to 54-year-olds, are typically at their peak earning years. They're a historically stable cohort that drives a huge amount of spending. The fact that their real earnings are falling is a new and powerful headwind for the entire economy. Interestingly enough, this could be a leading indicator, signaling a sharper than expected slowdown in core services and discretionary spending. That's just one piece of a bombshell new study from the JPMorgan Chase Institute. The report reveals a stunning reality. After you account for inflation, overall income growth for Americans has been crushed, falling to levels not seen since the slow, painful recovery from the Great Recession over a decade ago. The situation presents a fascinating duality. Back in the early 2010s, unemployment was hovering around a painful 7%. Today, it's a much lower 4.4%, yet real income growth is just as weak. For prime age workers, that growth is a meager 1.6% once you factor in rising prices. What this really tells us is that the headline unemployment rate can be a misleading signal of the labour market's true health. Think of it as a lagging indicator reflecting the past, not the present strength of the worker. After all, despite low unemployment, workers don't have enough bargaining power to demand wages that outpace inflation. This implies the underlying economy might not be as strong as the numbers suggest, and it increases the risk of a policy mistake if interest rates are kept too high for too long. And the rabbit hole goes deeper. It's not just older workers feeling the squeeze. The same study found younger workers are missing out on the strong income gains that typically define the start of a career, a critical engine for economic mobility. This is all happening right as the crucial holiday shopping season kicks off. This decision brings both opportunities for some and comes with inherent risks for others, setting the stage for what experts are calling a K-shaped holiday season. This means we'll likely see a major split in retail performance. Luxury brands are expected to do very well, catering to asset-rich households who are benefiting from the stock market. Meanwhile, discount retailers that serve the average wage-dependent family could struggle. This is a clear signal of deepening economic inequality. The JPMorgan Chase Institute warns that households are entering the season with weak income growth and bank balances that remain flat. But that's not the whole picture. The real turning point in understanding consumer liquidity is that this flat bank balance idea is actually more complicated. We're seeing a massive rational shift of money out of traditional low interest bank accounts and into high yield money market funds. In just one recent week, these funds saw an inflow of over $116 billion. This suggests many consumers actually have a larger, more liquid financial cushion than bank data alone implies, which could keep spending and services inflation stickier for longer. While strong stock market gains might seem like a safety net, the report is clear. Those gains are highly unequally distributed. And this has major implications beyond the US, especially for the Chinese market. A squeeze on the American consumer means weaker demand for many goods made in China. This is very different from the post-COVID boom that was fueled by US stimulus checks. This external drag puts pressure on China's economy, potentially forcing a choice between stimulating domestic demand or risking exporting deflation to the rest of the world. As a focal point to watch, we should keep an eye on China's new export orders data to see if this trend worsens. For the average consumer, the story is very different. The bottom line is this: while nominal paychecks may be rising, real purchasing power is at a painful low, fundamentally reshaping household financial health. All market data is subject to change. This is not investment advice.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.